What if I told you that there's a secret weapon buried deep within your charts, one that most traders overlook? And what if I said that by mastering this one powerful signal, you could spend just 10 minutes a day trading and make 10 times more than those glued to their screens all day? Sounds too good to be true, right? But this strategy is so effective, it's like having a crystal ball for spotting reversals and key market moves. In this video, I'm going to reveal exactly how you can use this game-changing pattern to level up your trading and achieve consistent profits. Ready to find out what this secret is? Stay tuned. Imagine spotting a subtle clue on your trading chart that could signal an impending market reversal. That's exactly what a pin bar does. A pin bar is a unique candlestick pattern, easily recognizable by its small body and long wick, showing rejection of a specific price level. That long wick? It's the market's way of showing that price tried to move in one direction but got quickly pushed back, hinting that the market might reverse. So, why should you care about pin bars in your trading? Pin bars are powerful because they can help you catch market reversals before they happen. Whether you're trading forex, stocks, or commodities, this pattern can give you an edge by highlighting potential turning points in the market. Plus, pin bars are incredibly versatile. They show up across different time frames and markets, giving you plenty of opportunities to use them in your strategies. So, what's the catch? While pin bars can offer high probability setups, they're not foolproof. Sometimes the market might fake you out, continuing in the same direction even after a pin bar forms. That's why it's important to combine them with other tools, like support and resistance levels or trend lines, to improve your accuracy. And that's what I'll show you, so don't skip any part and watch carefully, because this candlestick pattern, which you might overlook, can dramatically improve your trading account. Let's dive into what makes a pin bar so powerful in your trading. A pin bar is made up of three simple but key parts: a small body, a long wick or tail, and a short shadow. The small body represents the open and close prices during a specific time frame, showing minimal movement. But here's where it gets interesting: the long wick is where the action is. This wick tells you that the market tried to push prices in one direction but got smacked back, indicating rejection of that level. The short shadow on the opposite side just reinforces this, showing that the market couldn't move much in that direction. Now, when you see a bullish pin bar, it's often at the end of a downtrend. The long lower wick shows the market rejected lower prices, suggesting that buyers are stepping in, and a reversal could be on the horizon. On the flip side, a bearish pin bar shows up after an uptrend with a long upper wick. This means higher prices were rejected, and sellers might be about to take control. So why does the tail matter? The longer the tail, the stronger the rejection of that price level. A long tail means the market tested those levels and failed a clear signal that a reversal could be coming. This is what makes pin bars such powerful signals in identifying trend shifts and making your next trading move. So how do you spot a bullish pin bar? It's simple. Look for a pin bar with a long lower wick. This means the market tested lower prices but quickly rejected them, signaling that buyers are stepping in and pushing the price back up. You'll often see these bullish pin bars at the end of a downtrend, hinting at a potential reversal to the upside. When you see that long tail below the small body, it's like the market is telling you, nope, we're not going lower. Time to consider a long position. On the other hand, a bearish pin bar has a long upper wick, signaling rejection of higher prices. Sellers are taking control after the market tested those higher levels but failed to hold them. You'll usually find bearish pin bars at the end of an uptrend, indicating a possible downward reversal. It's like the market is saying, that's as high as we're going for now. Pin bars don't behave the same in every market condition, so understanding how they act in trending versus ranging markets is key to using them effectively. In a trending market, pin bars can be your best friend. In an uptrend, a bullish pin bar with a long lower wick often signals that the market rejected lower prices and is about to resume the upward movement. This can give you a great entry point to ride the trend. Let's start with the basics of an uptrend. An uptrend occurs when the market continuously forms higher highs and higher lows, signaling that buyers are in control. The price moves in two phases: impulsive waves, which are strong upward movements, followed by retracement moves, which are temporary pullbacks. These retracements are a natural part of the trend and give the market a chance to breathe before resuming the next upward push. Now, where does the bullish pin bar come into play? During an uptrend, a bullish pin bar often forms at the end of a retracement phase. The key feature of this pin bar is its long lower wick, which indicates that the market tried to push lower, but buyers quickly stepped in, rejecting those lower prices. This shows that the retracement is likely over, and a new impulsive move in the direction of the uptrend is about to begin. This creates an excellent opportunity for you to enter the trade with lower risk and higher reward. By placing your entry at the close of the pin bar, you're setting yourself up to catch the next impulsive wave as it starts, while keeping your stop loss just below the pin bar's tail to minimize risk. Essentially, the bullish pin bar gives you a reliable signal that the uptrend is about to continue, allowing you to take advantage of the market's momentum. By using pin bars to time your entries during an uptrend, you're not only trading in line with the dominant trend, but also improving your chances of finding high probability setups, which is a key principle in successful trading. In a downtrend, the market consistently forms lower highs and lower lows, indicating that sellers are in control. Price moves in impulsive waves followed by retracement moves. These retracements are short-lived as the sellers prepare to push the price lower again. A bearish pin bar typically forms at the end of a retracement during a downtrend. The long upper wick of the pin bar shows that the market tried to push higher, but sellers stepped in and rejected those higher prices, signaling that the retracement is over. This indicates that the market is likely to resume its downward impulsive move. This gives you a great opportunity to enter a trade with lower risk and higher reward. By placing your entry at the close of the pin bar, you're positioning yourself at the start of the next downward push, allowing you to ride the new impulsive wave. With a stop loss just above the pin bar's tail, you can minimize risk while maximizing profit potential. Essentially, the bearish pin bar provides a reliable signal that the downtrend is about to continue, allowing you to take advantage of the selling momentum and improve your chances of catching the dominant trend's next move. In ranging markets, the price moves sideways within a defined range, oscillating between support and resistance. In these conditions, pin bars tend to form at these key levels, offering potential trading signals. When a bullish pin bar forms near support, it suggests that the market tried to push lower but was rejected by buyers stepping in at that support level. This rejection can indicate that the price might bounce back toward resistance, presenting a good opportunity to go long. On the other hand, when a bearish pin bar forms near resistance, it signals that the market attempted to break higher but got rejected, indicating potential downward movement back toward support, a good opportunity to go short. However, trading pin bars in ranging markets comes with caution. Since the market isn't in a strong trend, false signals are more common. For example, a pin bar might form, but the price could still break through support or resistance, especially in consolidating or choppy markets where there's no clear direction. That's why it's crucial to combine pin bars with other technical tools, like volume analysis, oscillators like RSI, or price action patterns, to confirm the strength of the signal. When it comes to trading pin bars, choosing the right time frame is crucial for accuracy and reliability. The daily and 4-hour charts are generally considered the best for spotting pin bars. These higher time frames help reduce market noise, giving you clearer and more reliable signals. Pin bars on the daily chart can indicate strong potential reversals, as they reflect a full day's worth of market activity, which carries more weight than a single hour or minute. The 4-hour chart is also highly reliable, offering a balance between capturing medium-term trends and providing enough detail for more frequent setups. It's a great option if you want more trading opportunities without sacrificing too much signal quality. On the 1-hour chart, pin bars can still provide good setups, but they come with more risk. Lower time frames tend to have more market noise, meaning short-term fluctuations can lead to false signals. Price action on lower time frames is more reactive and can mislead you into thinking a pin bar is signaling a reversal when it's just a minor fluctuation in a broader trend. For this reason, it's generally better to avoid pin bars on time frames lower than the 1-hour chart, as these tend to be less reliable and require extra confirmation with other indicators. Focusing on the daily, 4-hour, and 1-hour time frames will improve your chances of success by providing more accurate and meaningful pin bar setups. Now that you've learned what a pin bar is and how it works, here's the real key: trading pin bars on their own isn't enough. Think of the pin bar as a signal, but this signal needs to appear in the right places to be effective. That's why combining pin bars with support and resistance levels can give you a serious edge in the market. These are psychological zones that the entire market, including major institutions and banks, watches closely. When price reaches these levels, something significant is likely to happen, and that's where pin bars can provide excellent trading opportunities. Support and resistance levels are crucial because they act as psychological barriers. Support is like a floor for the price when it reaches this level. Buyers often step in and prevent the price from dropping further. Resistance, on the other hand, is like a ceiling where sellers push back, preventing the price from climbing higher. These zones are where the market tends to react strongly, and pin bars that form at these levels often indicate a reversal or significant price movement. Let's say the market is in a downtrend, forming lower highs and lower lows. As price approaches a major support level, it starts slowing down. Suddenly, a bullish pin bar forms, the price tries to push lower, but buyers come in strong, rejecting those lower prices and leaving a long lower wick. This is your signal that the downtrend could be losing steam, and a trend reversal may be just around the corner. By placing your entry at the close of the pin bar, you're positioning yourself to catch the beginning of the reversal. You place your stop loss just below the tail of the pin bar, managing your risk in case the market turns against you. With the price potentially moving upward from support, the risk-reward ratio is highly favorable, giving you a chance to profit while keeping your losses controlled. Now imagine the market is in a strong uptrend, making higher highs and higher lows. As the price nears a major resistance level, a bearish pin bar appears with a long upper wick. This wick tells you that buyers tried to push the price higher, but sellers quickly stepped in and rejected those higher prices. This is a sign that the uptrend may be running out of steam, and a reversal could be on the horizon. You can take advantage of this by placing a short trade at the close of the pin bar with your stop loss just above the pin bar's wick. By doing this, you're positioning yourself to profit from the potential downward move, while keeping your risk low. The combination of a bearish pin bar and a key resistance level provides a solid, high probability setup. In a range-bound market, where price moves sideways between a well-defined support and resistance zone, pin bars can also be highly effective. When the price reaches the support zone and a bullish pin bar forms, it signals that buyers are rejecting lower prices. This is a great opportunity to go long, expecting the price to bounce back up toward resistance. Similarly, when price reaches the resistance zone and a bearish pin bar forms, you know that sellers are rejecting higher prices, signaling a potential move back down toward support. In these scenarios, combining pin bars with clearly defined support and resistance levels offers you clear, low-risk entry points with solid profit potential. To take your pin bar trading strategy to the next level, combining it with Fibonacci retracement levels, specifically the 50% and 61.8% levels, can give you a serious edge. When a pin bar forms at either of these key levels, it becomes what I like to call a golden pin bar pattern, a powerful combination that increases your chances of catching profitable market reversals or trend continuations. The 50% and 61.8% Fibonacci retracement levels are critical because they represent areas where the price tends to reverse after retracing a significant portion of its previous move. The 50% level marks the halfway point of a move, while 61.8%, often referred to as the golden ratio, is known for its reliability in financial markets. These levels are widely watched by traders, which adds even more weight when price action reacts at these points. Here's where the magic happens. Imagine the market is retracing after a strong move, either an uptrend or a downtrend. As the price retraces to the 50% or 61.8% Fibonacci level, you spot a pin bar forming. This pin bar, with its long wick, signals that the market tried to push through the Fibonacci level but was rejected. When this happens, you've got yourself a golden pin bar pattern. This pattern is powerful because it combines two strong signals. The Fibonacci level, where the market is likely to reverse or continue its trend. The pin bar, showing rejection of price at that level. By combining these two elements, you have a higher probability trade set up with clear entry and exit points. Let's say the market is in an uptrend, and after an impulsive move, it begins to retrace. You pull your Fibonacci retracement tool from the swing low to the swing high, and the 61.8% level aligns with a key support area. As price touches this level, a bullish pin bar forms, signaling that buyers are stepping in and rejecting lower prices. This is your golden pin bar pattern, telling you that the retracement is likely over, and the market is ready to resume the uptrend. You can place your entry at the close of the pin bar, with your stop loss just below the wick of the pin bar, keeping your risk low and maximizing your potential reward. Similarly, in a downtrend, if the price retraces to the 50% or 61.8% level and a bearish pin bar appears, this is your cue to enter a short trade. The pin bar's long upper wick shows that sellers are rejecting higher prices, signaling a continuation of the downtrend. So why the golden pin bar pattern works? Fibonacci levels, particularly 50% and 61.8%, are trusted by traders because they represent key retracement zones where the market often pivots. By adding a pin bar at these levels, you have confirmation that the market has rejected the retracement and is likely to reverse or continue the trend. This combination creates a highly reliable setup, giving you the confidence to enter the trade knowing that multiple factors are aligning in your favor. When trading with moving averages, you're essentially using them as dynamic support and resistance levels that follow the price action, unlike static horizontal lines. The 50-period moving average and 21-period moving average are particularly useful because they adjust with the market's momentum and can act as crucial zones where price tends to bounce or reverse. When a pin bar forms around these moving averages, it signals a high probability trading setup, as the market is respecting these dynamic levels. In an uptrend, the 50-period moving average and 21-period moving average serve as dynamic support levels. Price often retraces toward these moving averages before resuming its upward movement. These averages provide a flexible zone where buying pressure tends to re-emerge, making them excellent areas to watch for potential entries. In a downtrend, these same moving averages act as dynamic resistance. The price may rally temporarily but often gets rejected at these levels, as selling pressure increases when the price touches the moving average. Let's look at an uptrend scenario. The market is steadily trending higher, and the price consistently respects the 50-period moving average as dynamic support. The market starts to retrace, and as it approaches the 21-period moving average, a bullish pin bar forms, with a long lower wick, showing that the price tried to push lower but was rejected by buyers. This setup is a classic opportunity to enter a long trade at the close of the pin bar. The 21-period moving average has acted as dynamic support, and the pin bar signals that the buyers are still in control. You would place your stop loss just below the wick of the pin bar to minimize risk. As the uptrend continues, you're positioned to ride the next impulsive wave higher. Now let's examine a downtrend scenario. The market is making lower lows and lower highs, and price action respects the 21-period moving average as dynamic resistance. After a retracement, the price moves up toward the 21-period moving average, and a bearish pin bar forms, with a long upper wick indicating that the market tested higher prices but got rejected. In this case, the 21-period moving average is acting as dynamic resistance. A short trade at the close of the pin bar gives you a low-risk entry point, with your stop loss just above the pin bar's wick. As the downtrend resumes, the pin bar provides confirmation that the sellers remain in control. Moving averages are popular tools because they adapt to the market's current conditions, offering more flexible levels of support and resistance compared to static horizontal lines. The 50-period moving average and 21-period moving average reflect the trend's momentum, and when a pin bar forms at these levels, it's a strong indication that the market is respecting these zones. When trading pin bars, the entry method you choose can make a big difference in your trade's success. Let's go over the three main entry strategies: market entry, 50% retrace entry, and on-stop entry. Each approach provides its own benefits, and proper stop loss and profit target placement is crucial for managing risk and maximizing reward. For a bullish pin bar, you enter a buy trade as soon as the pin bar closes. You place your stop loss 10 pips below the pin bar's wick, or just below the nearest support level to protect against false breakouts. Your profit target should be set at the next resistance level, where price is likely to face selling pressure. For a bearish pin bar, you enter a sell trade at the close of the pin bar. Your stop loss should be placed 10 pips above the pin bar's wick, or above the nearest resistance level. The target for this trade is the next support level, where buyers are likely to step in. In a 50% retrace entry, you wait for the price to pull back to around the halfway point of the pin bar's total range before entering the trade. For a bullish pin bar, you place a buy limit order at the 50% retracement of the pin bar and your stop loss 10 pips below the pin bar's wick or the nearest support level. The profit target is again set at the next resistance level. For a bearish pin bar, you place a sell limit order at the 50% retracement of the bar. Your stop loss is placed 10 pips above the wick, or just above the resistance level, with your target being the next support level. With an on-stop entry, you place your buy stop order just above the high of a bullish pin bar, to ensure the market continues moving in the expected direction. For this trade, your stop loss goes 10 pips below the wick, or the nearest support level, with your profit target at the next resistance level. For a bearish pin bar, you place a sell stop order just below the low of the pin bar. Your stop loss should be set 10 pips above the wick, or at the nearest resistance level, and your target should be the next support level. By combining the right entry strategy with precise stop loss and profit target placement, you can trade pin bars effectively while managing risk and maximizing potential returns. And there you have it. A powerful strategy that can completely change the way you trade, giving you more time, more control, and potentially more profits. Now that you know the ins and outs of this game-changing pattern, it's time to apply what you've learned. But remember, success in trading comes from discipline, practice, and sticking to your strategy. So take your time, backtest this, and refine it until you make it work for you. If you found value in this video, don't forget to like, subscribe, and hit that notification bell so you never miss any of my future trading tips. Let me know in the comments what you think about this strategy, or if you have any questions, I'm here to help. Thanks for watching, and see you in the next video.